Tax loopholes are a great way to legally reduce or avoid taxes. They are legal deductions, exemptions, and credits available to taxpayers that reduce the amount of money they owe in taxes. Exploring these loopholes can help you save a significant amount of money in taxes and make sure that you don't overpay. With the right strategies, you can take advantage of these loopholes and make sure you pay the least amount of tax as possible. Whether it's using deductions, credits, or exemptions, there are plenty of legal ways to reduce your tax bill. In this video, we'll explore the different tax loopholes and how to use them to your advantage. We help teach people about money, personal finance, and investments. If you're interested in improving your financial future, make sure to subscribe to the channel and hit the like button if this video is helpful. 15 days of free rental income. The IRS does not require you to pay taxes on the income you receive from renting out your home for a maximum duration of 15 days. This could be an attractive option for people whose properties are situated in close proximity to an event that is held annually, for example, the Masters Golf Tournament or major college football matches. It does not matter what amount you are charging for the rental. You won't be obligated to pay taxes as long as it is for 15 days or fewer. HSA pays medical bills. If you have a high-deductible medical insurance plan, you can take advantage of a health savings account HSA to deduct your medical expenses from the first dollar. Just like an IRA, funds in your HSA are not taxable and can be used for any medical costs that take place after you open the account, regardless of when you made the contributions. You can save up to $7,200 for a family or $3,600 for a single person, and individuals aged 55 and above can add an extra $1,000 as a catch-up contribution. Deductions for deadbeats. You may be able to subtract an outstanding debt from your taxes if you have loaned cash to someone who hasn't returned it. Initially, this deduction was meant for businesses, but the existing loophole allows anybody to deduct a bad debt, even if the credit was given to a friend or member of the family. The loan must be entirely futile, and it must be a debt, not a gift. This implies that you should have come to a mutual agreement, ideally in writing, that the money would be given back. It also implies that there is no chance that you will ever get the money back. Generally, this implies that the individual who acquired the cash has filed for bankruptcy, or that you have made calls, sent letters, and asked for repayment. The home office deduction. If you have a section of your house allocated for a work area, you can subtract a corresponding amount of the cost of renovations in your house equal to the area the office occupies. So, if a home office is 5% of the total floor area of the house, you can then subtract 5% of the expense of setting up central air conditioning. Even if customers visit your home office and your home's presentation is deemed crucial to your business, the IRS will permit you to subtract costs for landscaping. The 529 plan. If you use a 529 plan to finance college expenses, you won't have to pay taxes on the gains you make from your investments. Moreover, some states will even provide you with a deduction on your income tax for your contributions. Furthermore, if you meet the necessary income requirement, you can also benefit from the American Opportunity Tax Credit or the Lifetime Learning Credit, which allows you to save money through tax-exempt growth of your college savings, as well as from the credits themselves. A pass-through business. Taxpayers who own a business that does not pay taxes, such as a sole proprietorship, partnership, or S-corp, are able to deduct 20% of their income from the business from their taxable income. This deduction is subject to certain income limits, as well as additional rules, depending on the type of business. Individuals earning less than $164,900 and couples earning less than $329,800 are eligible for the deduction. Taxpayers earning more than these limits must factor in wages paid to employees and investments in property when determining their eligibility. Savers tax credit. People with a low to moderate income who save money for retirement can take advantage of the Savers tax credit. This credit is worth up to $2,000 and is calculated at a rate of 50%, 20%, or 10% depending on the adjusted gross income of the applicant. To qualify for the full 50% credit, the adjusted gross income must be no higher than $30,000. Those with an AGI between $30,000 and $40,000 can get a 20% credit, and those with an AGI over $40,000 can get a 10% credit. It is possible to take the saver's tax credit, even if the applicant chooses the standard deduction, rather than itemizing mortgage interest deduction. For those taxpayers with a moderate income, the biggest tax break they can get is through their home. Buying a home allows them to claim the mortgage interest deduction, which implies that they can subtract the interest cost from their mortgage payment, though not the principal, meaning they will not be able to deduct their entire monthly payment, just the interest payments, for the year that meet the requirements. This deduction is most advantageous when you decide to itemize deductions. When the amount of the mortgage interest deduction is greater than the standard deduction, it will be more cost-effective to itemize. The life insurance loophole. If you have a life insurance policy, which has a cash value, you can borrow money from it. This is similar to an individual retirement account IRA, in the sense that the cash in the policy, not used for insurance premiums, grows without attracting any federal taxes. Over a period of time, the cash value in the policy increases beyond the death benefit. If the insured person dies, the beneficiaries get the death benefit without any federal income tax. However, if the estate is huge, they may need to pay estate tax on the proceeds. You can also borrow money from your policy while you are alive, and this loan will also be free of income tax. However, you must pay the loan back with interest to the insurance company. If you don't, the company will pay it with the cash value of the policy. Eventually, the payments could be more than the cash value of the policy, and the policy will lapse. This will mean that you will have to pay taxes on the amount of the loan, which is higher than the premiums you paid into the policy. Conclusion. The IRS encourages certain activities by offering deductions on taxes. These deductions can save you a substantial amount of money, so it is worth exploring the deductions you are eligible for. Tax loopholes may either be deductions that reduce the amount of taxable income or credits that reduce the amount of tax due. It is essential to keep in mind that taxes and their loopholes are complex, and this video is not meant as professional advice. Before implementing any of these deductions, you should always make sure to check with a tax specialist. Thanks for watching, and please don't forget to like and subscribe.